start this. Let's just start this. Let's just start. Okay, thanks very much for joining. My name's Andrew Talbot, and I'm coming from a very wet Singapore today. We're live on YouTube, so if you're watching it on that, then you want to ask some questions, then you're going to have to get in touch with us by the channels that we will tell you at the end of the presentation. If you're on Zoom, which is the webinar software, then by all means ask some questions, and I'll try and pick them up as we go along. But today it's going to be basically a 20-minute webinar about what is your financial independence number. And if I just start the show, we can talk through that. Just share this. There we go. So yeah. What is your number, or what is your financial independence number? And this is really the amount of money that you will need to live off without depleting the capital or your net worth. So if you got a lump sum in the bank, for instance, and you draw the money off there, how much is needed before you deplete it all, or trying to get to that point where you're not depleting it? We'll come on to some theory about how to construct this. A lot of assumptions around the numbers that work, why they don't work, and some strategies to really sort of help you understand this. Being expat, because this is an expat financial planning webinar, it does add a little bit more complications into it, in the fact that we've got currency, we've got different jurisdictions. The main question, what we're trying to ask is, will you outlive your money, or will your money outlive you? Which is generally the big worry for people who come into retirement from a lot of studies that you see. So how much money will you spend in retirement? And obviously that's a very difficult question to answer. The nearer you are to retirement, you can see that people have a greater understanding of what that figure is. But I mean, start with a budget, which is normally quite a word that people don't like. So we always say use a spending plan. What's your spending plan? How much you spend every month. The closer you are to retirement, the more you'll understand how accurate this figure is. So we'll come on to some of the factors that will affect this shortly. But the financial independence number is to try and work out that number that you don't have to work for. So it doesn't necessarily mean you're retiring early, you just may stop work or do something else. But you've got to understand how much you spend, because that's one of the big factors in it. And costs will always go up in the future, unless you have massive deflation. So you've got to bear that in mind. And these are some of the assumptions to think about. So the factors that will affect your retirement, your health. The older you get, the cost of insurance increases. That depends on the age and obviously your health. If you don't have a national health service or a state health service, then you need to have insurance to pay for this. If you're an expat and you're living in 3 different countries, and it depends on the particular situation of your state insurance position or the health insurance that you buy. Obviously, the level of income that you would need to retire on, you've got to work out how much you spend. But some of the other factors include the currency and the tax. So currency is huge for expats because it can move so much that it doesn't really make a difference to the investments if your currency goes against you. And on reverse, it can go with you. Also, the tax systems in different countries are obviously going to be very different. So if you're trying to plan what your income level is, you've got to understand what the local tax position is and whether or not that's going to impact, it will impact you, but how much it's going to impact your income level. And then property, you've got to have a place to live. what's the state of the country that you're living in? Why are you living there? Are you renting or are you owning it? And then the other one we've noticed is travel. So if you're an expat, you tend to have, and you're living in a couple of different countries, you tend to have an expat family, and the kids have obviously been, they may have been educated overseas, therefore they've got expat friends, and then they are more likely to travel. So they'll go to university in different countries, to probably what you would have done. And then they've got friends, they're more likely to live overseas. So certainly traveling to see them. The case of myself, my parents, my in-laws will come and see us because they want to see their grandkids. So you've got to bear that in mind if the travel tends to increase into retirement. So where will you live? Quite a complex graph this, but it's trying to show you that it depends on what your quality of life is. So if you're living in a developing world, then your quality of life might be higher for the price that you can get in a developed world. And it really depends on the country that you're planning to retire to, or a couple of countries that you're planning to retire to. So understanding how much your income will go in that country is important. Again, we talked about the health costs. Is there a state health cover there that you can use by paying your taxes, or do you have to pay insurance costs for that? So understanding the position of the country that you're going to live in is important. And do you rent there? Can you rent there, or can you buy a property? It really depends on the individual tax position and the ownership of property, or generally the tax system of that country. So you've got to understand what the difference is between the countries. And then really we're trying to see into the future. So what's going to make a big difference to the assumptions in the future? So obviously your expenses, how much do you need to spend? We talked about developing countries or developed countries and the standard of living that you wish to have. Some unforeseen events, and this is normally sort of health cover, for instance. But remember that you've got long-term care, and then you're traveling to see the kids. These are the unforeseen events that will have a big impact on your income levels when you're retiring or when you become this financially independent. So how much do you need? So if we go on to a concept or one theory, and I'll go through some of the advantages and disadvantages of this. But for instance, this is called the safe withdrawal rate. And it's a number that was calculated, 1998, but I think it's been around for a while. And it's trying to look at how much you can take every year from your investment portfolio. And the investment portfolio generally tends to be equity based without depleting that capital. The study looks back to like 1925. It went through all of the different periods, and it came up with a figure of 4%. So this is the magic number when we're trying to look at how much you can withdraw from your investment portfolio. And this has lots of the different assumptions. So there are some issues with it. We'll go on to a little bit more detail shortly, but it's really a sweeping generalization and also a high level look at it. If you're looking at your own individual portfolio or your own individual position, then I think you need to go into a lot more detail. So if we look at an example of what that would be, quite simple. As I said, it's high level. If you wanted to retire on 50,000 a year, dollars, pounds, euros, then you will need, that independence number is 1.25 million because it's 4% of that. If you wanted to create multiple streams of income, which what we have described here in this infographic, you can see that if someone wants to generate 100K, then they can get it from, in this example, 5 different sources or streams of income. So rental income, property, part-time consultancy work, your investment income, a conventional pension, and then there's some state security or state pension. So the 4% withdrawal rate would refer to effectively this investment income, is 20,000. I'll give you an example. Mr. and Mrs. Smith, UK nationals, born in the late 50s, lived overseas 20 years, kids lived in different parts of the world, and then they're trying to live in the UK and then a home in Europe. And they've decided that they want 75k a year to live. So they worked out what their spending plan is. They worked out their travel. They worked out that they may need some insurance on their health cover. And they've looked at, well, how much they want to spend every month. And they come up to 75k. They both receive a state pension of 8,000 per year. Okay. Mr. Smith has got a conventional pension scheme that gives him 35k a year, really good pension scheme. And then they've got a buy-to-let, providing a rental income of 12k. So it's not a unexpected case study, probably quite a good one for these people. Therefore, they're short of 12k. If we pick out that withdrawal rate of 4%, then they need a portfolio of 300,000 to generate the 12,000. Okay, so that's quite a, again, high level, effectively back of an envelope, trying to work out where this income comes from, but it's a starting point. What about the assumptions? The assumptions are the big thing. So inflation. So if you're living in a developing world because you want that good standard of living, then the inflation rate is likely to be a lot higher than is it in a developed country, just because the economic cycles, the way that the country is going through that growth levels, inflation does tend to be higher. Probably catch up to itself to the developed world eventually, but you're talking decades to get to that level, I think. So you got to understand that the inflation level is going to have an impact on your real income level. So if you're in these developing countries because you've got good standard of living, then that is likely to change over the future. So maybe that 4% doesn't necessarily work in this scenario, or you need to really sort of refine it further because the inflation level is going to increase. The investment return also needs to be more than 4%. So in that study, they obviously went back to 1925 because that's when they've got the most amount of data, and they said, well, that's the return of equity markets. So if you stayed in that long, your investment return obviously has to do that. So you have to understand, well, what's your investment model? What are you looking at in terms of your current portfolio? Your house, for instance, it might provide an income, or a buy-to-let product might provide income. And in Mr. and Miss Smith's case, they had that income level. Well, that doesn't necessarily mean it's going to be the same into the future. And then what's the risk level? There's upside and downside. If you want more than 4%, then you're probably going to have to take a little bit more risk. But if you're taking less than 4%, you're going to be very cautious. And therefore, are you being too cautious? You've got to understand the risk. And the risk is dependent on your own position. Okay, there's environmental factors that we'll take into account. There's other assets that will have an impact on this. So it's really your own personal position on what you think it would be. And then obviously we talked about currency and tax systems and where you would be and how that will have an impact on the level of income. So what about course corrections? So we can't plan for every possible scenario, but we can consider sort of a wide range of scenarios. And you're trying to sort of see into the future, as we've said before. So modeling those spending strategies, trying to visualize the impact of like a market condition. And then this is what we do when we're using our financial planning software. So if we looked at this little infographic, you can see there's lots of different areas that will have an impact on this forecasting, and we call it cash flow forecasting. So it's trying to, again, visualize what the future looks like. So if we took Mr. and Mrs. Smith, they've now got kids, a little bit younger. So this was obviously a few years ago. The numbers along the bottom are their ages. So you can see we're trying to model 50 years worth of their life. And their kids are going to go to school, they're going to go to university, they're going to retire. So it's quite a linear case study for this. But if you're trying to do the course corrections, maybe the kids don't go to university. Maybe their spending will increase in retirement, or it'll be less than what they visualize. So that you don't really know. So we're trying to update it. If I was to plan their future again, you can see that the red part is the shortfall. This is their future. The timeline is their ages, and the blue bars are their income every year. The black line is their expenses. If their expenses go up or go down, then that shortfall will either decrease or increase. If inflation is more than we expected, there's going to be a greater shortfall. If their investment returns are better than what we expected, then the shortfall is going to be less. So you've got to understand when you're doing the modeling, how we're trying to apply it to your own personal income and lifestyle. To get rid of that 10,000, we've worked out that John and Jane, for instance, would need to just save an extra 10K a year. But again, what if they retire later or retire earlier? Then that figure is going to change. So it's very fluid. And the plan is always good as soon as you present it, but then straight after that, it's out of date because inflation levels change. The income levels will probably change into the future. So you've got to understand what that means. So start with a goal and a financial plan. How much money do you need to achieve that goal? How many years you got to go? What's your risk profile? What's your savings rate? What's your investment rates? And they're all very dependent on your own position. Your risk level, your savings rate, and how you want to allocate the investments is going to be down to your own individual position. Monitoring, again, is something that I've tried to reiterate throughout this, that it's important to have that level of monitoring just to make sure that the assumptions are always going to be good, still on track, etc. So bear that in mind. So let's do a quick to-do list. Very, very simple. Again, high level, not necessarily into too much difficult detail. Work out what your goals are. Consider the time scale. Consider how much risk you are. Think of the currency and tax, where you're going to live, what the standard of living is. Select the vehicle that you're going to use, and we'll come on to what I mean by that in a second, and then construct a portfolio. Make sure you monitor it. It's very important, the monitoring of those goals and the assumptions that go with it. So I talked about vehicles just a minute ago. So if we look at the why, which is the financial plan, why is the most important part of anything? It's understanding, well, what do you want to do? So you want to get to that financial independence figure. Okay, so you've got to work out what that figure is. So it's all of the planning that we've just talked about, doing the spending plan, etc. Step 2 is, well, what vehicle do you use? And that could be anything. That could be a house, property, it could be a bank account, it could be an investment, it could be an insurance policy. It's just a vehicle in order to get to the why part. The where bit is the bit more the detail you have within that vehicle. So it's the allocation to shares or bonds. It's where that house is situated. It's in Europe, it's in Asia. It's the cash in that bank account. It's the detail that goes into that vehicle. So you've got to understand which step you're looking at and always refer back to step 1, the why. Why are you doing this? And then how are you going to get to that level? So if you want to get in touch with me, by all means, these are the details. Have a look at the website, Expat Financial Planning. It's got a lot of detail on there, lots of calculators and a couple of quizzes, I think, articles, some videos. Have a look at that. And then if you've still got further questions, then by all means, these are the different channels that you can contact me on. So if you're unsure, look through the YouTube video again, and then by all means, get in touch with me. But, thank you very much, and hope to see you next time.